The topic of cash in today's small to medium-sized businesses is a vitally important one. The ability to control cash through budgeting and an accurate recording process taking into account solid internal control concepts should enable businesses to achieve good short and long-term cash flows. In the short term, cash flow is more important than profitability, but in the long term, both are necessary for business success. Cash is defined as not only money, but credit card and EFTPOS sales as well. While a business may not have the money in the bank immediately from a credit card or EFTPOS sale, it is still considered in the cash balance as being received. Cash is an asset subject to theft, and therefore good internal control features around receipts and payments are important. All too often we hear of businesses being defrauded by employees who find weaknesses in internal control procedures for cash and manage to steal large amounts of money before being detected. These thefts can be reduced with the application of some simple but effective internal control procedures. The bank reconciliation process is a system whereby a business's cash records are compared to the bank statement to reconcile, or in simple English, to bring together both sets of accounts to arrive at the true situation regarding the cash balance. For example, if we just rely on our own cash receipts and payments records, we will miss any direct debits and credits being made in and from our bank account. Some examples of these are regular payments being made from our cash account, bank fees, and customers paying directly to our account. And if we only rely on the bank statement, we will miss any undeposited cash amounts not yet taken to the bank, unpresented checks, and errors in our own recording. While checks are fast becoming a thing of history, and more businesses are paying and receiving cash through electronic means, petty cash is still important, and therefore its control and recording will reduce theft and accurately record any small cash payments. The ability to prepare a cash budget is an accounting skill necessary in our personal lives as well as in business. Surprisingly, there is not much difference between the two. How will we get cash and what will we spend it on? The cash budget ignores non-cash items and only focuses on cash inflows and outflows. While different to the cash flow statement, where cash is broken up into three sections, operating, investing, and financing, the cash budget is an internal statement and can be done in many ways. For small business, the simpler the better. A cash budget will highlight in advance any cash flow problems such as deficits and at times surpluses. This topic will show you what decisions can be made if either of these options exist. Good cash management can be achieved through accurate budgeting, comparing the budgets to the actual figures and making decisions about the differences, through knowing the receipt pattern of accounts receivable, knowing when to pay accounts payable and avoiding late payment penalties, managing inventory levels, and planning for capital expenditure. So, finally, the analysis of multiple short-term cash flow ratios becomes very important in a business with good cash management.